Assalamu alaikum and hi. Today we will be discussing International Accounting Standard number 2, the inventories, the stocks. Sometimes we are considering these two standards. As I mentioned in my last lecture of International Accounting Standard number 1, I will paste the link of that lecture in my description of this video. So if you haven't watched that video, you can have the reference of that lecture. We consider when I was a student and when we are a student, we consider these two standards, International Accounting Standard number 1 and International Accounting Standard number 2, as in very unimportant. Or when you start your job as an inventory accountant, inventory controller, there are so many petty issues involved in this standard, but we overlook that. So we will be discussing the International Accounting Standard number 2 in very detail today in this lecture. So we will start with a small video. As I mentioned that we are considering this inventory is a very simple thing. Nowadays, the world has been a global village. Things are so complex. We are going towards the modernization. The new technology is everywhere. You see that inventories are stored in the warehouse with the people are working in it, the machinery, the barcoding, the RFIDs. So how the inventories will be recorded in the financial statements, this will be our topic of discussion of today. So outline of my presentation will be the overview of International Accounting Standard number 2, the scope, the definitions involved in the standard, how we measure the inventories, how we recognize the inventories in our financial statements, and last but not the least, the disclosure of inventories in the financial statements. Overview and objective. IAS 2 sets out the accounting treatment for the inventories, means how the inventory will be treated in the accounting terms, including the determination of cost, that what should be the element of the cost and what should not be. Here the primary issue is that the amount of cost to be recognized as an asset and carry forward until the related revenues are recognized. Obviously, when this inventory will be sold, the revenue will be recognized. The subsequent recognition of as an expense, if any part of the inventory will be recognized an expense or not, or whole of the inventory will be recognized an expense, we will see in this lecture, and any write downs to the net realizable value. There may be a lot of reasons we will consider in this lecture, that what are the reasons for the write downs, whether the wastages, pilferages, obsolescence. There are so many factors we will consider in this lecture today. In addition to this, the standard also gives guidelines on the cost formulas that are used to assign cost to the inventory, means what cost be the part of the inventory. Scope of IAS2. The IAS2 applies to the all inventories. I am repeating this thing. This standard applies to the all inventories, except there are two exceptions: financial instruments under IAS 32 and IFRS 9, and biological assets arising from the agriculture activity under International Accounting Standard number 41. This standard does not apply to the measurement of inventories held by. So when you are reading the standard, you will have an opinion or in the mind that maybe the standard does not apply on these two things. No, the main thing is this standard does not apply to the measurement of the inventories, because we have a section in the International Accounting Standard 2 where we will see that how the inventories will be measured. These two exceptions will be that the standard will not be applied on that. What are those things? The first one is the producers of the agriculture and forest products, minerals and mineral products that are measured at the net realizable value in accordance with the well-established practices in those industries. And secondly, the commodity brokers who measure their inventories at the fair value less cost to sell. The brokers, what they are doing is they measure their inventories as, because fair value less cost to sell. Maybe that inventory needs some cost that will be incurred to sell that inventory. So they are deducting from the fair value of that inventory, and changes in the above inventory values are recognized in the profit or loss in the period of change. Means, for example, maybe the cost of inventory was a different one, the fair value amount of the inventory is different, so that difference will be in the profit and loss in the period of change. So we will have a small detail of this thing. regarding the agriculture products, that the agriculture products are measured at the net realizable value. We will go through the definition of what the actual net realizable value will later on in this lecture. So measure at the net realizable value at certain stage of the production. Now, why is that? Because when the agri crops have been harvested, or the minerals have been extracted, and sale is assured under either the forward contract and the government guarantee, because sometimes the government put a ban and there are certain regulations that you have to sell these things as per the law of that country. So that is why these things are measured at the net realizable value, because they will be selling at a certain point of time, and or when the active market exists and there is a negligible risk of the failure to sell. So that is the reason. The above are the reasons that these inventories are recorded are exempted and excluded only for the measurement requirement of this standard. This was the first thing, that the agriculture products are exempted measurement of inventory, because the normal inventory will be measured according to the guidelines of the standard. But we will be measuring the inventories of the agriculture and the forest products and mineral related products very differently. Means, as I mentioned, that are measured at the net realizable value at certain stage. Similarly, who are brokers or the broker traders who buy or sell commodities for the others on their own means. For example, person A is a broker, he has the inventory in his control on behalf of someone. So for this, such inventories are required with the purpose of selling in the near future and generating profits from fluctuating in the price or broker trader's margin. This is the reason these two things are excluded for the measurement of the inventories. Now we will see some of the definitions. Inventories. What is an inventory? Stocks. Stocks are the assets. These are the part of the current assets. When you will see if you're a new student or a new person who started job or who started the professional career in the finance right now, when you will see the balance sheet part in the current assets, there will be one portion that is called the inventories, stocks, stores, and spares. These are the current assets, and we will consider this. Now, what is the definition of those inventories? Inventories are the assets that are held for sale in ordinary course of business. For example, a merchandiser or a retailer, those merchandiser or retailer purchase the items to resale. This is their ordinary course of business. So they are holding that inventory to sell it. So that is called the inventory. Second one is in the process of production for such sale. If you are a merchandiser or a retailer, you are purchasing from somebody else, but sometimes the organizations are producing the same things themselves. So in the process of production, maybe raw material, work in process, finished goods. These are the three main categories that are the sub part of the inventories. In the process of production for such sale means they say, or in the form of materials or supplies to be consumed in the production process or in rendering services. Now, I will relate this thing with the second thing. Materials or supplies to be consumed in the production process. As I mentioned, that maybe the company is producing itself. So there are some materials or supplies that will be used in this production process. That will also be a part of the inventory or in rendering services. Here I can relate one example. If any organization is providing a plumbing services, so there are so many things with which the personnel or the person who is rendering the services is using the equipment. So those equipments will also be a part of the inventories. The second definition is net realizable value. The most common term used in the IAS2 will be the net realizable value. Now, what is the net realizable value? This is the estimated selling price less the estimated cost of completion and the estimated cost necessary to make the sale. Now, here there are two things. The first one is the selling price less estimated cost of completion. Again, I will relate this thing with this production process that I am producing myself. So selling price less estimated cost of completion. How much cost it will be incurred to complete that process, to complete that inventory. So we will less That is the net realizable value. And the estimated cost necessary to make the sale. Sometimes you are selling the inventory and there are a few expenses where it will be incurred to make the sale necessary. That may be some of the governmental charges, or if you have provided the, as we mentioned earlier, to somebody else, and he will charge you certain commission. So that estimated cost necessary to make the sale, because with the help of that person or without the help of that person you cannot make the sale. So that cost was necessary to make the sale. So we will deduct that amount from the estimated selling price. So that is the net realizable value. Net realizable value is the entity specific value and fair value is not. So sometimes net realizable value is not equal to fair value less cost to sell. The third definition is cost of inventories. All costs incurred in bringing the inventories to their present location and condition, including the cost of purchase and conversion. Now, all the cost incurred in bringing the inventories to their present location in the location and condition. Sometimes you have a raw material that is also the inventory, but you have to incur something on it. Maybe the handling charges, the transport charges. So you have to incur some cost to inventories to their present location and condition, including the cost of purchase and conversion. You purchase the raw material and then again you incurred some more expenses to convert that raw material into finished goods. That will be on the part of the cost of the inventories. Secondly, the cost of purchase of inventories comprise the purchase price. Now, the cost of purchase, what is the cost of purchase? We have the formula. The cost of purchase of inventory comprise the purchase price less trade discounts, rebates, and similar items. Means from the cost, the purchase price, we will deduct any trade discount at the time of the purchase, rebates, and similar items. Okay, we will deduct. And again, what we will add, irrecoverable taxes, any tax that will not be recovered from the government, that is not refundable, that is the full and final tax. Then the transport, bringing the raw material or the inventory from one location to the other location. As I show the video, the people were using the forklifts to bring the inventory to the racks. Handling and the other cost, obviously, the personnel who were working over there, they were handling the inventories. The salaries of those workers will be the handling cost, and other cost directly attributable to their acquisition. There was a warehouse facility. Obviously you have to pay the rent, or if you have your own, obviously that expense is directly attributable to their acquisition. So the cost of purchase will be this, as I mentioned. The cost of conversion includes the cost directly related to the units of production. Means if you have the raw material, you are converting that raw material into the finished goods. That cost, the conversion cost, is directly related to the units of production. For example, the labor working on it, the electricity used, these are the cost, or the rent of that factory. These are the direct costs, such as the direct labor, systematically allocated fixed and variable production overhead. Normally, whenever we are spending, we have the two types of the cost. One is the fixed cost, that is and one is the variable. Fixed cost is, for example, rent. If you produce 1 unit, you have to pay full rent. If you produce 1,000 units, you have to pay the full rent. So that is fixed cost. And variable, if you will produce 1 unit, the cost of the raw material is only for the 1 unit. If you are producing 1,000 units, the cost of raw material is for the 1,000 units. Now, such as the direct labor and systematically allocated fixed and variable production overheads incurred in producing finished goods. Last one is the fair value. Now, what is the fair value? The price that would be received to sell an asset or paid to transfer a liability in orderly transaction between the market participants at the measurement date. So it is very important that the fair value is the current value. Sometimes you have the inventory, maybe later on the value is maybe less or more, so that at the measurement date, whatever the two parties decide, that will be the fair value. Other costs. The other cost will be included only to the extent that they are incurred in bringing the inventories to their present location and condition. Sometimes I will tell you that other cost will not be a part of the cost of the inventory, but sometimes there are chances that that other cost was inevitable, and the total other cost will not be added to the cost of the inventory. What will be added only to the extent that they are incurred in bringing the inventories to their present location condition, means any raw material on which you have to pay something to bring that inventory to the present location or condition. Present conditions means raw material cannot be sold. After you convert it into the finished goods, then you can sell it. So the only the extent which was necessary, that will be the part of the inventory. Now here, the examples of the cost excluded from the cost of inventories will be the abnormal amount of wasted materials, labor, or other production cost. Sometimes, for example, if you are doing a business of any agriculture products, you have the inventory of that agriculture product, you have stored it and you have to sell it. Sometimes there are wastages while moving those inventories. So that will not be a part of the cost. Labor or other production costs. Sometimes there may be chances that you have to hire a labor that is not directly attributable to the inventory, or any production cost that was incurred and that was not necessary or directly attributable to the inventory, so we will exclude those costs. I can give you an example that maybe a person who is hired for a security of the inventory, and he's also working for the admin or some other offices as well. So we will not add that cost into the inventories. Storage costs, unless those costs are necessary in production process before a further production stage. Sometimes when you have the raw material, so it may take several steps to convert that raw material into the finished goods, maybe stage 1, stage 2, and stage 3. So the storage cost will not be a part of the inventories unless, why? Those costs are necessary in production process. Means if those costs are necessary, it will be a part of the inventories. But if those are not, we will not before a further production stage. Third one was administrative overheads that do not contribute to bringing inventories to their present location and condition. Means any administrative cost. For example, we have hired an auditor to check the process, so that hiring of that auditor was not necessary. So administrative overheads that do not contribute to bringing inventories to their present location, so it will not be directly attributable and it will not give you any benefit directly. So we will consider that cost as well. And lastly, the selling cost. Sometimes you have to pay something to sell that inventory. So selling cost, any commission, for example, you are paying to the persons who are selling. So it will not be a part of the cost of inventory. And the last one is IAS 22.3, borrowing cost identifies limited circumstances where the borrowing costs are included in the cost of inventories. Sometimes you have borrowed an amount and you are paying interest on it, and there are very limited circumstances when the borrowing cost will be part of the cost of the inventories. Measurement of inventories. Inventories shall be stated at the lower of cost and net realizable value. This is very important thing. Whenever at the end of the year, the inventory count is done by the auditors. They are just following an exercise and doing an exercise of stock count. What they will do is they do a small exercises, and they ask the management to do the same exercise, that they have to value their inventory. That the inventory shall be stated at the lower of cost and net realizable value. For example, if the cost was 1000 and net realizable value is 900, so we will record the inventory as 900 and remaining 100 will be recorded as an expense in the financial statements in the profit and loss. The second one is to the extent that the service providers have inventories. To the extent that the service providers have inventories, they measure them at the cost of their production. Mean, for example, you are producing some software, okay, so they measure them at the cost of their production, how much cost it is incurred to produce that thing. These costs are primarily the cost of labor directly, the person working on it, engaged in providing the services, including supervisory personnel and attributable overheads. So, as I mentioned, that if you're producing something, the salary of the supervisor personnel and attributable overheads, those overheads that are directly attributable. Here I can give the example if the electricity cost and machine is working, so we can directly attributable that this machine used this much units and we can directly relate that overhead cost to that process. So that will be part of the measurement. The cost of inventories of items that are ordinarily interchangeable. Sometimes the inventories are interchangeable. For example, you can take the example of a medicine A, Panadol, and obviously the new stock came and that was Panadol. So these are the interchangeable. So what process we do is and have not been produced and segregated for specific projects, and it is determined by using the first in first out or weighted average cost formula method. So as per International Accounting Standard number 2, you can use two methods. The first one is first in first out, means the stock you purchased first will be out and used first, or sometimes you can use as a weighted average cost formula. But as I gave you the example of a medicine, obviously the medicines have the expiry, so what you will do is the medicine which was purchased first will be issued first. So again, I will repeat this thing. This is very important concept. The cost of inventories of items that are ordinarily interchangeable and have not been produced and segregated for specific projects. If these things are for a specific project and you can segregate for the specific project, then you will utilize those inventories to those specific products. But if these two are not the cases, then what you will do is first in, first out, or weighted average cost formula. The same cost formula shall be adopted for all inventories having a small similar nature and use of entity. Means if the inventories have a similar nature, same entity is using, so you will use these formulas. Last one is inventories are usually written down to the NRV on an item by item basis unless it is more appropriate to group similar or the related items. As I mentioned that when the auditor is coming or it is asked by the auditor to the management that you have to measure your inventory lower of cost and net realizable value. Maybe there are 1,000 items in the warehouse. So what you will do is you will do the written down item by item. You cannot say that in the 1,000 items maybe 10 items were there who were those items were lower of cost to net realizable value, but the remaining 90 items were okay as per cost. So you cannot apply that percentage to overall inventory items. So what you have to do is it is must the standard asks us to go for the item by item basis unless it is more appropriate to group similar items or the related items. If the items are similar, the inventories are same, or the items are related, so you can do is you can apply it on the group, but otherwise else the standard says that you have to apply that written down or adjustment on the item by item basis. There are two other methods as well I mentioned in the standard. The one is the standard cost method or the retail method. The second one is there are two methods. The first one is standard cost method, and the other one is the retail method. Standard cost method, the normal as we discussed in the standard. The retail method is normal level of material and supplies, labor efficiency and capacity utilization. These are regularly reviewed and if necessary revised. Retail method is you see the normal level of material and supplies, labor efficiency and capacity. You are reviewing regularly. In the standard cost method, you are not reviewing these things regularly. But if you are using the retail method, you have to revise those things as per the current conditions. Now, retail method is used in the retail industry. Large number of rapidly changing due to the large number of rapidly changing items with similar margins for which it is not possible to apply costing method. So sometimes if the merchandiser has a number of thousands of the items, so he cannot apply the costing method item by item, so he is using the retail method. Recognition as an expense. Now which inventory will be part of the expense? When inventories are sold, The carrying amount of those inventories should be recognized as an expense in the period in which the related revenue is recognized. For example, the revenue was recognized in 2020. So, by using the matching principle, the carrying amount of that inventory will be recognized in 2020. I will repeat it again. When the inventories are sold, for example, inventories are sold in 2020, revenue will be recognized in 2020, the carrying amount of those inventories will be recognized in expense in the 2020. Any loss of inventories and the amount of any write down to the net realizable value shall be recognized an expense in the period in which the loss or write down occurs. For example, as I mentioned that we have some losses in the inventories. Or in the last slide, we did an exercise that lower of cost or net realizable value. Cost was 1,000, net realizable value was 900. So what we do with that 100, we will expense out any loss of the inventories and amount of written down. That 100 will be considered as write down to the net realizable value because the cost was 1,000, net realizable value was 900. So we are writing down our inventory to the net realizable value. It shall be recognized as an expense in the period in which the loss or write down occurs. Lastly, any reversal of the inventory. Here, one thing comes to my mind is, for example, at the year end, the inventory was the part of your current assets, but the net realizable value came less. So the carrying amount of the inventory will be less. It will be sold later, but the loss portion or the write-down portion will be recognized as expense in this year. Lastly, any reversal of any write-down of the inventories that resulted from an increase in the net realizable value shall be recognized as a reduction in the inventory expense in the period in which the reversal occurs. For example, the vice versa of this can happen is that sometimes the net realizable value becomes more. So the reversal will be recognized in the same period in which the reversal in which as a reduction in the inventory in the period in which the reversal occurs. For example, same, we did the write down in this period when the write down was occurred, and reversal same, we are recognizing in the same period. Last but not the least, the most important thing, if you are preparing this thing for the exam, maybe the questioner can give some of the data, and he can ask you that you have to present these things as per international financial reporting or international accounting standards you have to disclose. So the following shall be disclosed in the financial statements. The accounting policy for the inventories. I will give you the practical example. I have one of the financial statements with me. The total carrying amount of the inventories. The carrying amount of the inventories carried at the fair value less cost to sell. As I mentioned that there was one thing, the broker thing. If you are dealing in the broking business, so you have to mention that thing. The carrying amount of the inventories carried at fair value less cost to sell. The amount of inventory is recognized as an expense during the period we have to disclose. The amount of any write down of the inventory is recognized as an expense. The amount of any reversal of any write down that is recognized as a reduction in the amount of inventories recognized as an expense. The circumstances or events that led to the reversal of write down, because this is not the normal thing, reversal of the write down. So you have to mention those circumstances, conditions, reasons why that was reversal. So in the narrative form you have to show this in the notes to the financial statements. And lastly, the carrying amount of the inventories pledged as security for the liabilities. It is also very necessary for the user of the financial statements. So let me show you the practically what we present in the financial statements. Here I have the financial statements. So we will go before the financial statements. Notes to the financial statements. We discussed the accounting policy for the inventories. The financial statements have been prepared on the historical cost basis except for the following material items in the statement of financial positions. So we mentioned the methods used to measure the fair values are described in the further respective policies. So we mentioned the policy as we discussed, accounting policy for the inventories we mentioned, the total carrying amount of the inventory. When we go to these are the notes. First, we will see the balance sheet where the inventories are here. Stores in the current assets. In the statement of financial position, current assets, stores, spares, and loose tools. Note number 18, the amount, stock and trade. So we will go to the note number 18 and we will see there it is. The carrying amount of the inventories. Let's zoom this. 18. This is 18.1. We will go to the previous page. Store, spares, and loose tools. Store, spares, store, spares. This is the carrying amount. Total, sorry, this is the total amount. Less provision for slow moving, obsolete, and in transit stores. We reduced, now this is the carrying amount, 17 million. And we said that we have to disclose the carrying amount of the inventories, carrying amount of the amount of inventories recognized as an expense. This write down was as an expense, 2.9 million. The total carrying amount and the total carrying the amount of inventories recognized in expense. So we mentioned this thing as well. So on the next page, the movement, the movement of the provision for slow, it was 2.9 million. Reversal provision, as I mentioned, that there will be write down or the reversal we have to show. So we mentioned over here reversal or provision for the year. So it was a reversal because it's deducting. So the balance is 2943223. So these are the main things that we will be disclosing in our financial statement as the part of the inventory. So this was the topic today. I hope you will be benefited with this video. If you like it, or subscribe the channel because I'll be making the same type of the videos for all of the international accounting standards and the financial reporting standards. So hit the like button, share it with your friends, and if you have any questions or the feedback, you can just drop it into the comments box. I will reply you